Everyone thinks silver is boring, a slow metal, an old commodity, something that just sits there doing nothing. But what if I told you that right now, one of the most powerful financial institutions on earth has been quietly positioning itself for a silver event so violent, so asymmetric, that most investors won't even understand what happened until it's already over? What if I told you that JPMorgan didn't just buy silver, they stockpiled it, not a few million ounces? Not a hedge, not a short-term trade, 169 million ounces of physical silver. And the real question is not if this matters. The real question is, why would a bank this powerful something this extreme unless they know something the rest of the market doesn't? Because banks don't move like retail investors. They don't speculate emotionally. They don't chase hype. They move early. They move early. They move quietly. And when they move ahead of structural shifts, not headlines. So let's ask the uncomfortable question most people are avoiding. Why would JPMorgan accumulate one of the largest silver positions in history, right before a potential supply collapse, right before industrial demand explodes, right before the paper silver system starts cracking? And why are almost no mainstream analysts talking about it? Stay with me, because by the end of this video, you'll understand why silver isn't just undervalued. It may be mispriced by hundreds of %, and why the people who ignore this story may one day look back and say, how did we not see this coming? Let's start with something simple. Banks don't hoard metals for fun. They don't tie up billions of dollars in physical assets unless the risk reward is absurdly asymmetric. So when JPMorgan began quietly accumulating silver years ago, it wasn't a coincidence. It was a strategy. But here's where it gets interesting. They didn't just accumulate paper contracts. They didn't just hold futures. They took delivery. Vaulted silver, real bars, physical metal. Why does that matter? Because paper silver is easy to create. Physical silver is not. You can create 1,000 paper claims for every real ounce. And that's exactly what the system has done. But when a bank demands physical delivery, it stresses the entire system. And JPMorgan didn't just do this once. They kept accumulating year after year, until eventually their silver holdings reached a level so large that it raised a disturbing question. What do they know about the future of silver supply that the rest of the market is ignoring? To answer that, we need to talk about something most investors don't understand. Silver isn't like gold. Gold is mined for gold. Silver? Silver is mostly mined as a byproduct. That means silver supply is not controlled by silver demand. It's controlled by copper demand, lead demand, zinc demand. So even if silver demand explodes, supply doesn't respond quickly. And now ask yourself this. What happens when industrial demand for silver surges, but mining output doesn't? You get shortages, not price dips, not volatility, structural shortages. And that's exactly what's forming right now. Silver isn't just a precious metal. It's an industrial metal hiding inside a monetary disguise. Solar panels need it, EVs need it, medical devices need it, electronics need it. Military technology needs it, and none of these sectors are shrinking, they're accelerating. Here's the problem. Every solar panel uses silver, and there is no efficient substitute. EV adoption is increasing, and EVs use more silver than traditional vehicles. AI infrastructure is expanding, and AI hardware requires ultra-high conductivity metals. So while investors are distracted by memes and headlines, silver is being consumed, used up, gone forever. Unlike gold, which can be recycled almost endlessly. Now ask the critical question. If silver is being consumed at record rates and supply can't increase quickly, what happens to the price? Historically, when silver shortages emerge, price doesn't move slowly. It snaps, it jumps violently, it gaps upward. And this is where the idea of a silver squeeze comes in. But not the fake social media-driven squeeze people talk about. This is something much bigger. This is a physical delivery squeeze, and JPMorgan positioned themselves before it became obvious. But wait, why would JPMorgan, a bank often accused of suppressing silver prices, suddenly flip and accumulate massive physical holdings? That's the question most people get wrong. They assume JPMorgan is bullish. That's not the full story. JPMorgan doesn't bet on direction. They bet on control. By holding physical silver, they do something extremely powerful. They protect themselves against paper market failure. If futures markets break, if delivery defaults occur, if trust in paper contracts collapses, who wins? The entity holding the metal. And here's the uncomfortable truth. The silver market is one of the most leveraged markets on Earth. For every ounce of real silver, there are dozens, sometimes hundreds, of paper claims. That works until too many people ask for delivery. Then the system breaks, and when it breaks, price discovery resets violently. This is why JPMorgan's accumulation matters. They aren't chasing upside. They're preparing for disorder. Now let me ask you something. If you were running a global bank and you saw signs that industrial demand was outpacing supply, that paper leverage was becoming unsustainable, that geopolitical tensions were increasing, that currencies were being debased, would you want exposure to physical silver? Or would you want to be trapped holding paper promises? JP Morgan answered that question years ago, and they answered it quietly. But the market is starting to notice. Inventory levels at major exchanges have been declining, delivery delays are increasing, premiums on physical silver are widening, and yet the price hasn't reflected the reality yet. Why? Because paper markets can suppress price temporarily, but they cannot suppress physics. When real supply runs out, price adjusts instantly, not gradually. And this is where the idea of a 500% move comes from. Not hype, math. Silver is historically cheap relative to gold. Silver is historically cheap relative to industrial demand. Silver is historically cheap relative to monetary expansion. And when silver reprices, it doesn't creep, it explodes. Look back at history. Silver doesn't move for years, then it moves in months, then in weeks, then in days. And the people who waited for confirmation miss it. Now ask yourself this. Why would a bank with access to unlimited information, data, and market insight accumulate silver before retail investors wake up? Why not after? Because once the squeeze begins, there is no liquidity, there is no supply, there is no second chance. The real silver doesn't come back to market. And here's the part that should really make you pause. JP Morgan isn't the only one. Central banks are hoarding hard assets. Governments are stockpiling strategic metals. Supply chains are being reshored. Trust in fiat currencies is eroding, and silver sits at the intersection of money, industry, and geopolitics. That's a dangerous combination, because it means silver isn't just an investment, it's a pressure point. Now let me ask you the question that matters most. What happens when institutions rush for physical silver at the same time? You don't get a bidding war, you get a vacuum. Price gaps upward until sellers appear. And when sellers don't appear, price resets to a level that forces supply out. That's how squeezes work. Not because of hype, but because of scarcity. And scarcity doesn't negotiate. So when you hear the phrase 500% squeeze, it's not saying silver will go up tomorrow. It's saying the conditions exist for a move so large that it shocks the system. And JP Morgan positioned themselves before that shock. Now here's where you need to think carefully. This isn't about copying JP Morgan. You don't have their balance sheet, you don't have their risk tolerance, but you do have something else. Time. And time disappears fast once the narrative shifts. Because once silver breaks out, the story changes overnight. Suddenly analysts care, suddenly headlines appear, suddenly everyone always believed in silver. But by then, the easy money is gone, the asymmetry is gone, the physical supply is gone, and the people who understood the story early are already positioned. So the real question isn't, will silver go up? The real question is, what happens if it does and you did nothing? Because history shows that silver doesn't give polite invitations. It moves when pressure becomes unbearable. And pressure is building right now, quietly, relentlessly. And institutions like JP Morgan aren't guessing. They're preparing. Now here's what I want you to do. Don't take my word for it. Don't take headlines at face value. Look at inventory data. Look at industrial demand trends. Look at delivery reports. Look at who's taking physical possession. Then ask yourself one final question. If silver really was irrelevant, if it really was boring, if nothing was coming, why would one of the most powerful banks in the world quietly stockpile 169 million ounces? They don't do that by accident. They do it because they see the storm before the clouds appear. And when the squeeze begins, most people won't even understand what happened. They'll just see the price and wish they asked better questions earlier. If this video made you think differently about silver, if it made you curious, if it made you question what institutions are really doing behind the scenes, then make sure you subscribe. Because this channel doesn't follow headlines, it follows signals. And if you want to know what the smartest money is doing before it becomes obvious, stay here. And comment below one thing you learned that changed how you see silver. Because the biggest shifts don't happen loudly, they happen quietly, until suddenly they don't.